Hi, I'm Don Chambers, Chief Investment Officer of the Model Portfolios at Biltmore Capital Advisors. Today I'm discussing closed-end funds. It's a strategy that is used at Biltmore to enhance the risk-adjusted returns of our clients. Closed-end funds are a special type of mutual fund, so I'm starting with a quick overview of the more common types of mutual funds. Most people are familiar with open-end mutual funds. These are the more common mutual funds issued by many investment companies such as Fidelity, T. Rowe Price, Vanguard, and others. People invest in open-end mutual funds by buying shares directly with the company such as Vanguard, or by having their broker make the investment with the company on their behalf. The key to this common type of mutual fund is that the sponsoring company, such as Vanguard, creates new shares when an investor wants to buy shares and redeems those shares when the investor wants to sell the shares. Vanguard and other investment companies issue and redeem shares at the fund's daily net asset value, or NAV. Net asset value is a key issue in all types of mutual funds, so I want to take a minute or two to explain net asset value carefully and clearly. Let's discuss a hypothetical mutual fund called the Vanguard Open-End Stock Fund. Suppose at the end of a business day, Vanguard calculates the total value of the investments held by the Vanguard Stock Fund as being $10 million, and they calculate that there are exactly 1 million shares held in that fund by various investors combined. At the end of that day, Vanguard would calculate the daily net asset value by dividing the fund's total portfolio value, in this case $10 million, by the total number of shares in the fund held by all of its investors, in this case 1 million shares. In other words, Vanguard would calculate the per share net asset value of the fund by dividing the total portfolio value by the total number of shares, generating $10 per share. Having calculated the $10 net asset value, Vanguard would then cash out the shares of investors wishing to sell or redeem their shares by sending those shareholders $10 for each share they wish to redeem. At the same time, Vanguard would sell new shares to investors wishing to buy shares by collecting $10 per share from each investor and putting the $10 per share into their portfolio. Some investing companies charge fees for these services by issuing new shares at a price that exceeds the net asset value. These are loaded mutual funds, which we do not use at Biltmore. We use no-load mutual funds only, so we can buy and sell shares at the fund's net asset value. In recent years, a new type of mutual fund has soared in popularity, the exchange-traded fund, or ETF. ETF investors can enter and exit ETFs by buying and selling shares on a major stock exchange, such as the New York Stock Exchange. ETFs allow investors to trade at any time during the day, and they have other advantages, such as convenience and possibly avoiding some of the potential income tax problems with open-end funds. Biltmore Capital often uses ETFs because of their low fees, tax advantages, and other reasons. The key to ETFs is how the price at which the shares trade on the stock exchange is very closely tied to the net asset value of the fund. This is ensured by the actions of institutional investors who can create and redeem new shares directly with the fund company if and when the ETF's price deviates from its NAV. This process ensures that investors are almost always assured that they can trade their positions through the stock market at a price that is very closely tied to the portfolio's net asset value. To illustrate, the chart shows the daily market prices of a major exchange-traded fund and its net asset value for the last month of 2018. I picked December 2018 because of its high volatility. Note that the net asset value and the market price of the ETF are almost always exactly the same. There is one day, Christmas Eve, for which the difference is more than a few pennies. That can happen on major holidays when the trading day is light. But most of the time, the ETF's price is very closely linked to its net asset value. Given the potential tax advantages and lower transactions costs of ETFs, we at Biltmore find these to be great ways to invest our clients' hard-earned money. Now let's turn to closed-end funds, which are somewhat like a blend of the other types of mutual funds I've been discussing. Like exchange-traded funds, closed-end funds are traded on the New York Stock Exchange or other major exchanges. However, the big difference between a closed-end fund and an exchange-traded fund is that there is no automatic feature forcing the market price of the closed-end fund to track its net asset value closely. For example, Please examine this graph. This is a graph of the market price and net asset value of a fund that Biltmore often uses to enhance returns for its clients. The ticker symbol of the closed-end fund is BTT. Notice that unlike the ETF shown earlier, the market price of BTT does not track its net asset value closely. Let's take a close look at the difference between the fund's market price and its underlying net asset value by expressing the differences as premiums or discounts of the market price. This graph focuses on the discount as being the area below the horizontal axis and a premium when the fund's market price is above its net asset value above the horizontal axis. When the fund trades at a large discount, wide investors can enjoy the benefit of buying $1's worth of net asset value for much less than $1. Note that the market price usually sells at a substantial discount from its fund's underlying net asset value. When a closed-end funds trade at a large enough discount from its net asset value, we at Biltmore Capital Advisors have generated enhanced returns for our clients by buying it at a large discount and eventually selling the fund at a smaller discount. It just makes common sense. For example, a 10% discount of the market price from its net asset value means that an investor can gain the benefits of $1 of the fund's underlying assets with an investment of only 90 cents. It seems too good to be true, but often there is a major catch. Savvy investors know that these closed-end funds tend to have high management fees and other expenses. Because the closed-end funds have higher fees, the market price tends normally towards a discount from its NAV to reflect the fact that shareholders are not receiving all of the cash flows from the fund's underlying assets. These fees explain why most closed-end funds trade at a discount. But note also that the graph shows that the discount fluctuates. The discount reached a high of about 14% in 2014 and 2018 and fell to only 1 or 2% in 2017. So the goal of closed-end fund investing is to identify funds at an attractive discount and hold the ETF until its discount returns to a normal range. Let's take a look at a graph of a fund that covers a long time period. This graph is representative of a number of funds that have been in existence for a long time. This particular fund is a fund that I have often invested in over the last 2 decades. Note that the discount of the funds tends to return to a level of perhaps 10% or so, but sometimes soars to having little or no discount and other times falls to a large discount of 20% or more. The largest discounts tend to occur when existing shareholders are selling their shares during a time of poor returns in the overall financial market or the sector in which the fund invests. But sometimes the fund discount rises or falls simply due to the actions of various investors to sell or buy their shares based on individual circumstances. Perhaps they sell their shares to pay their child's tuition bill or buy shares with a bonus check from their employer. Either way, sometimes the discounts rise or fall for reasons unexplained by the performance of the overall financial markets. The point is that these fluctuations offer opportunities to improve returns by buying when the discounts are inappropriately large and selling when the discounts are smaller. I've been trading closed-end funds for my own account and for that of clients for over 30 years. Picking the right funds and the right times to transact is not as easy as it may appear from that graph. There are many issues to consider, such as the fund's distribution rate, any provisions to terminate the trust, the breakdown of the expense ratio between interest expense and other expenses, and so forth. The key takeaway is that Biltmore Capital does not simply pour its client money into passive indexes that track the market. We implement strategies that are designed to enhance the risk-adjusted returns of our clients in the long run. Closed-end funds are one of our most important tools in that effort. The strategy has risks. For example, closed-end funds do rather poorly in a market crisis, but they do very well when the markets recover from that crisis. We take this risk into account and keep client exposures to closed-end funds relatively modest during periods of market strength. I hope that this video has provided a clear introduction to closed-end funds and our efforts at Biltmore Capital to implement time-tested and economically sound strategies to provide our clients with attractive long-term risk-adjusted returns. The professional financial advisors at Biltmore Capital and I, as CIO, welcome your comments and questions on closed-end funds and other aspects of our efforts to serve our clients. Please contact us to learn more about our closed-end fund strategy and other strategies designed to build a brighter financial future for our clients and for their families. Thank you.